Welcome to the deep dive. We're here to sift through those dense financial reports, the research, and pull out the insights that really matter.
Exactly, cutting through the noise.
Today, we're putting Goldman Sachs under the microscope. We've got their second quarter 2025 earnings call transcript and the presentation that goes with it.
Yeah, and the big question is, what can a giant like Goldman tell us about the economy right now?
Right. And how are they playing their cards? They talk about shifting market dynamics, heightened uncertainty. Sounds, well, uncertain.
It does. So our mission today is to unpack that, look beyond just the numbers, get into their strategy, the trends, and what it actually means.
For you listening, for the market, all of it.
It feels like a really crucial time for this kind of deep dive. I mean, the whole economic picture seems so fluid. And looking at Goldman's results, what grabs me isn't just the raw numbers, which are strong, but how resilient they seem in this uncertain environment you mentioned.
Okay, let's get into it then. They called Q2 strong performance.
They did.
And the headline numbers seem to back that up. Net revenues, $14.6 billion.
Wow.
Earnings per share, $10.91. And return on equity, ROE, that was 12.8% for the quarter.
And didn't they mention the half-year ROE too?
Yeah, good point. For the first half, it was even higher, 14.8%.
So pretty robust. And the CEO gave some color on why.
Right. They pointed to, and I'm quoting loosely here, best-in-class talent, a culture of collaboration, and their, differentiated businesses, investment banking, financing, risk intermediation, asset and wealth management. It's a whole package.
It's that integrated model again. They also made that bold claim, didn't they, about their client franchise?
Oh, yeah. Global client franchise has never been stronger. Big words.
Well, maybe not just words. I mean, look at how their financing business keeps growing. We'll get into that. But it does suggest real client traction.
True. We should also mention, just for clarity, there were some selected items. They knocked EPS down by 33 cents and ROE by like 40 basis points.
Right. So the underlying performance was arguably even a touch better. Good to keep in mind.
Okay, so a strong foundation. But how are they actually doing it in this environment? Let's look under the hood. Investment banking first.
Yeah, let's. Because everyone's asking, is deal-making back? Is that engine finally firing on all cylinders?
Well, Goldman seems to think so, or at least getting there. They called the M&A environment remarkably resilient.
Resilient? That's interesting phrasing given the uncertainty backdrop.
It is, and they threw out some numbers, announced M&A volumes up 30% year over year.
30%, that's significant.
And it's even 15% higher than the 5-year average for the same period. So not just a blip, it seems.
Okay, so what's driving it, according to them?
CEO confidence, mainly. They feel there's a narrowed range of outcomes on things like trade and the general economy. A bit more clarity, maybe.
Makes sense. Less extreme possibilities means it's easier to pull the trigger on deals.
And we saw some big ones. Energy buying that portfolio from LS Power for $12 billion. Salesforce picking up Informatica for $8 billion. Real deals happening.
And it wasn't just M&A, right? Yeah. Capital markets, too.
Yeah, that accelerated. They priced 11 IPOs globally. Names like Circle, Chime, eToro, HDB Financial Services.
And they mentioned those performed well after listing.
They did. Performed well in the secondary market was the phrase.
Okay, so what's fascinating here, I think, is that connection between the sort of softer economic sentiment improving and this very real pickup in deals.
Yeah.
Especially because, let's be honest, we've heard predictions about M&A rebounds before that didn't quite pan out.
True. This time feels a bit more concrete, maybe, especially with the backlog number.
Ah, yes, the backlog. What do they say about that?
It rose again for the 5th consecutive quarter.
5th? Wow.
Driven mostly by advisory, and it's up significantly versus 2024 year-end levels.
So that pipeline looks pretty healthy.
Seems like it. They still acknowledge, uncertainty in some pockets, but the overall tone for investment banking felt pretty optimistic.
Okay, so a healthy backlog, strong M&A, that definitely paints a positive picture for that side of the house.
But it's not just the traditional stuff, right? There's this other piece, maybe less flashy, but really important, strategically financing.
Ah, yes. Their big push on financing, it's been a multi-year thing for them, hasn't it?
Yeah.
Driving growth, maximizing wallet share.
Exactly. And, well, it seems to be working. Really working.
How so? What were the numbers?
Both financing businesses hit revenue records this quarter. Records.
Oh, okay.
Record fixed financing revenues, $1 billion. And record equities financing revenues, $1.7 billion. That equities number is up 23% year over year.
23%. That's huge growth.
So total financing revenues, a record $2.8 billion. And get this, it's their sixth consecutive quarter hitting a record.
Sixth. Okay, that's not just a trend. That's a juggernaut.
Right. And it now makes up over a third of their total FICC and equities revenues, their trading businesses.
Wow, over a third. That's a fundamental shift in the revenue mix.
It really feels like it. 6 quarters of records.
Yeah.
It suggests they're really getting that wallet share they talk about.
And they mentioned gains with top clients, didn't they?
They did, these hard-won share gains. They now rank in the top 3, like relationship-wise, with 125 of their top 150 clients globally.
125 out of 150. What was that number before?
Back in 2019, it was only 77.
Okay, that is a big jump. That shows real progress in deepening those relationships.
It feels like that virtuous cycle they aim for, You provide financing, you get stickier, you get more connected.
And then more M&A, more trading, everything flows through your system.
Exactly.
It does make you wonder, is it just Goldman executing well, or are clients also consolidating who they work with? Probably a bit of both.
Probably, but that deep engagement is clearly a strength. And speaking of clients and managing assets, that takes us neatly into asset and wealth management.
Right, another area showing some serious growth. What were the highlights there?
Assets under supervision, or AUS, hit a new record, $3.3 trillion.
Trillion, with a T.
Yep. And here's another streak for you. Their 30th consecutive quarter of long-term fee-based net inflows.
30. That's 7.5 years of consistent inflows.
Incredible consistency, isn't it? Plus, they raised $18 billion in alternatives this quarter. Wealth management assets also hit a record $1.7 trillion.
And they're lending more to those wealthy clients too, right?
Yeah, making good progress there. Loan balances to ultra-high net worth clients are up to $42 billion.
Okay, but this raises an interesting point, maybe a slight contradiction, because M&A is booming. Right. But Goldman mentioned something about a challenging harvesting environment for their own older investments, leading to losses.
Yeah, good catch. That is a key nuance. They did have modest net losses in their private portfolio, mostly driven by real estate markdowns, they said.
So strong M&A market overall, but tricky for them to sell off their own historical stuff. What's going on there?
It's about what they're trying to sell. This harvesting refers to exiting their older historical principal investments. Think direct private equity real estate holdings they made using the firm's own capital years ago.
Got it. The stuff on their own balance sheet.
Exactly. They said they're still committed to aggressively reducing that portfolio. It's down to about $8 billion now.
Which is much smaller than it used to be, I gather.
Much smaller. And they described it as, like, the stickier part of that old portfolio. Harder to sell.
So this really highlights their strategic shift, doesn't it?
Yeah.
Moving away from being a huge on-balance sheet alternatives player.
And more towards managing third-party money, a more capital-light model in that space.
Makes sense? Less risk, more predictable fees. Okay, let's pivot. Something impacting everyone. AI.
Artificial intelligence. Yeah, Goldman sees it, unsurprisingly, as a huge deal, quickly developing into an economic force that will permeate every industry.
So how are they approaching it? It sounds like it affects them in 2 main ways.
Exactly. Twofold impact. Externally, AI creates demand, right? Infrastructure needs, financing needs for companies investing in AI that drives business for Goldman.
Okay, the external opportunity. Makes sense. But what about internally?
That's where it gets really interesting, I think. They're not just talking about it. They're actively using it to change how they work.
How so? Any specifics?
Yeah, they rolled out a natural language GSAI assistant across the whole firm.
Okay.
And they emphasize it's the first generative AI-powered tool to reach the scale for secure access to approved large language models. That's a big deployment for a firm their size.
Secure access being key there, I imagine.
Absolutely. And they're also working with Cognition Labs, piloting this thing called dividend.
Devin, what's that?
It's an autonomous generative AI agent. The idea is it could basically transform how they build and maintain software, like an AI software developer.
Wow. Okay, that's ambitious.
Very. The expected benefits, they talked about enhancing velocity, transforming capabilities, driving efficiency, better productivity, better client experience.
It's not just cost-cutting then. It's about fundamentally changing workflows.
That's the message.
And if you zoom out, this internal adoption at places like Goldman, it's a massive tailwind for the whole market, isn't it? Driving efficiency everywhere.
Definitely a space to watch. Okay, shifting gears again. Let's talk capital. Hugely important for a bank.
Always. How are they looking on that front?
Pretty strong. Their main capital ratio, CET1, is at 14.5%.
And their requirement is going to be
10.9% starting October 1st. So a nice buffer there.
decent cushion.
Yeah.
And what about the stress tests? CCAR.
Yeah, they highlighted a significant improvement there. Their expected stress capital buffer, the SCB, came down to 3.4%.
Which is better than last year, right? I remember there was some confusion then.
That's putting it mildly. They
Yeah.
called last year's reaction incredibly confused. They attribute this year's improvement to being less RWA dense, basically holding less risky assets, relatively speaking.
Okay, a cleaner result this time. Makes sense.
And with that strong capital position, they're definitely signaling confidence through shareholder return.
Oh yeah, like dividends.
Big time. They upped the quarterly dividend by 33% to $4 a share.
33% increase.
Wow, they said it underscores their confidence in the durability of our franchise. And just for context, that dividend is up 400% since early 2018.
400%. That's quite a trajectory. And buybacks, too.
Yep. They've got a $40 billion multi-year buyback program authorized. And in Q2 alone, they returned $4 billion to shareholders through dividends and buybacks.
So clearly prioritizing returns. Do they have a target buffer they like to keep?
Yeah. Their operating philosophy is to run with about a 50 to 100 basis point buffer over the regulatory minimum. So between 0.5% and 1.0% extra capital.
Prudent, but still confident enough to return significant capital. That balance.
Exactly. It also ties into the broader regulatory picture.
How so?
They sounded encouraged by regulators talking about a holistic review of the whole capital regime.
The ongoing debate about bank capital rules.
Right. They specifically mentioned recalibrating the enhanced SLR, that's the supplementary leverage ratio, as a constructive step.
So they're hoping for maybe a slightly less stringent environment, or at least a more balanced one.
I think that's the goal. They talked about fostering a more efficient financial system and supporting U.S. growth and competitiveness. It's all part of that dialogue around getting the rules right.
Yeah, finding that balance between safety and efficiency, it's crucial.
So, pulling it all together, what's the outlook? What are they saying about the road ahead?
Well, the tone seems pretty positive overall. They reinforce the good outlook for M&A and investment banking.
Right, building on that backlog.
And they expect their markets business, the trading side, to remain robust and diverse.
And long-term, that mid-teens ROE target.
Still the goal.
Yeah.
15 to 17% ROE in the medium term. They see that coming from continued growth in asset and wealth management, plus the performance in global banking and markets.
Seems like a clear path. Did they mention any, new frontiers?
Yeah.
Emerging stuff?
They did touch briefly on tokenization, digitizing assets on blockchains.
Interesting. What's their take?
They see potential opportunities, especially around funding. Think it could take friction out and create new possibilities, but they're waiting for regulatory clarity.
Sensible. Watch this space then.
Definitely. But even with all the positive signs, they didn't shy away from the uncertainties.
No, the CEO was clear on that. Much remains uncertain, was the closing sentiment.
What were the main worries listed?
Geopolitics, especially the Middle East, trade agreements that haven't materialized yet, and the potential impact of higher tariffs.
Yeah, those are big macro unknowns.
And they added that classic disclaimer, developments rarely unfold in a straight line.
Wise words. So the message is optimism, but tempered with caution and risk discipline.
Exactly. Focus on risk management. Help clients navigate this fast-evolving operating backdrop. That seems to be the mantra. Adaptability is key.
So wrapping this deep dive up, it really feels like we got a good picture of Goldman navigating complexity.
Yeah.
The resilience in deal-making was pretty striking. The financing growth is clearly a strategic win for them, deepening those client ties.
And the AI stuff isn't just talk. It's happening internally, changing how they operate.
Right. Plus that confident stance on capital returns, even while acknowledging the regulatory flux, it sends a strong signal.
Absolutely. And hopefully digging into a giant like Goldman gives you, listening, a kind of unique window into those bigger economic currents and trends.
A shortcut to getting smart on what's really driving things.
Definitely. So here's a final thought to chew on as we finish. Think about that AI piece. Goldman is using it to change software development, daily workflows. What happens when that kind of AI sophistication scales up everywhere?
Yeah. How does it reshape not just companies, but the whole structure of the economy?
Exactly. What new risks pop up? What totally new opportunities are created? And maybe most importantly, what kind of financial advice and services will be needed in that future?
Something to ponder.
Hmm.
How do you prepare for that shift? It's a big question.